morning and welcome to our monthly house view. The Strait of Hormuz remains closed, energy prices are still high, yet equity markets are going higher. So how do you explain this apparent disconnect?
Yes, energy prices have taken a backseat for equity investors for two main reasons. First, economic fundamentals are very solid, especially in the US. And second, the earnings season has been strong, especially for the tech sectors. The energy sector has also seen a surge in profit following the war in Iran, and the other sectors have shown some resilience despite the war. It's also interesting to know that capital expenditures are becoming a key metric for investors that feeds into the global AI ecosystem. In April, semis, hardware, and media accounted for 50% of the equity rebound in the US.
The combination of higher inflation and slower growth is really a challenge for central bank. How do you assess the monetary policy after the meetings that took place in April?
For central bankers, slower growth and the supply shock is very difficult, especially for their abilities to give forward guidance. We think that central bankers are a bit reluctant to use forward guidance, but also to tighten monetary policy too strongly, too early. In Europe, we think that growth concerns are more important than inflation risk, but if energy prices don't go down in the coming months, the ECB is very likely to hike interest rate in June. In the US, we think that the Fed will keep monetary policy on hold, with the possibility of the Fed cutting interest rate in December if inflation does not increase too much. But we think that the new president of the Fed, Walsh, will have limited scope to push FOMC members to a more dovish stance given the strength of inflation and quite resilient economic activity in the US.
And so how do these elements are translating into our portfolios?
So following the ceasefire, we decided to increase slightly the exposure to equities, specifically on US equities. But the key question for investors is whether or not equity market can sustain this momentum facing very high energy prices. So this is why we keep a small underweight in equities in our asset allocation. During the month, we also decided to buy some alternative assets with low correlation to equities. It is also a way to use the cash that we raised by selling fixed income allocation earlier in the year.
Okay. So to summarize, we increase risk within portfolios, but we remain cautious considering that energy supply disruption remain in place. Thank you for listening and see you next month.